So, in the wild world of electric vehicles, there's a huge puzzle unfolding right now. We're at the start of 2026, and a company, NIO, is selling cars like you wouldn't believe, smashing records left and right. But if you look at its stock price, you'd think the company was in serious trouble. So what is going on here? That's the paradox we're going to decode. Okay, let's just start with this number because it really sets the stage. By the end of 2025, NIO was just shy of delivering 1 million cars in total. I mean, they are right on the doorstep of a massive milestone that puts them in the big leagues. From a purely operational standpoint, this is a story of incredible success. All right, first up, let's dive into the good news, because wow, there's a lot of it. The numbers coming out of 2025 show a company that is absolutely on fire. It didn't just grow, it pretty much exploded. I mean, just look at how they finished the year. In December alone, NIO delivered over 48,000 cars. That's a new monthly record for them, and it's a nearly 55% jump from the same time last year. That's some serious momentum to be carrying into the new year. And this wasn't just some one-month fluke, not at all. The whole fourth quarter was a record smasher. We're talking about deliveries rocketing up by almost 72% compared to the year before. Now that's the kind of explosive growth that should have investors absolutely ecstatic. So let's zoom out and look at the whole year. All told, for 2025, more than 326,000 cars found new homes. Again, this isn't a startup anymore. This is a company that is scaling up and fast. And this chart really puts that growth into perspective. Deliveries jumped by almost 47% from 2024. The ramp up in production and sales isn't just steady, it's getting faster. Now, here's the really smart part. This growth isn't just from pumping out more of the same model. It's being driven by a multi-brand strategy that's clearly working. You've got the main NIO brand for the high-end premium market, then you have ONVO targeting families, and Firefly for those who want a smaller but still high-end EV. They're covering all their bases. Okay, so you see all these incredible numbers, and you're thinking, man, NIO's stock must be going to the moon. Well, this is where our story takes a really sharp and frankly very confusing turn. Right? I mean, it's the question that every single person following this company is asking. The logic seems so simple. Record sales should mean a rising stock price. But for NIO, the reality has been the complete opposite. Just look at this. It's wild. On the very day they announced those record-breaking December numbers, the stock didn't just fail to go up, it dropped more than 7%. And it's a pattern. Time and time again, amazing operational news comes out and the stock sells off. And hey, don't just take my word for it. This isn't just a random observation. Financial analysts have spotted this clear, counterintuitive trend. This Fentel report basically says there's a total disconnect. Good news for NIO, the company, does not equal good news for NIO, the stock. So the billion-dollar question is why? To get to the bottom of this, we have to look past those shiny delivery numbers and dig into the financials. We've got to pop the hood and see what the engine really looks like. And this is where we start to find some answers for why the market is so hesitant. And here it is, the core conflict in a nutshell. On one hand, you have the good news, their vehicle margin is getting better. That means they're making more profit on each individual car they sell, which is exactly what you want to see. But on the other hand, you have the big challenge. The company as a whole is still losing a staggering amount of money. We're talking a net loss of almost 3.5 billion RMB in just one quarter. That's the cost of building out that massive battery swap network and launching new brands all at once. But NIO has an ace up its sleeve. You could even call it their secret weapon, a unique part of their business that could totally flip this financial script. And thanks to a new government rule, that secret weapon just got a whole lot more powerful. It all comes down to their battery as a service model, or BaaS. Think of it like this. Instead of buying the single most expensive part of an electric car, the battery, you just buy the car itself. Then you pay a monthly fee, like a subscription, to use NIO's batteries and swap them out for a fresh one in minutes. Now here's where it gets absolutely brilliant for NIO. As of this year, 2026, China changed its EV tax policy. The tax you pay is now based on the car's invoice price. Well, for NIO's BaaS customers, that big, expensive battery isn't on the initial invoice, so their taxable amount is way lower. It's like the new policy was tailor-made for NIO's business model. And we are not talking about pocket change here. This gives NIO customers a direct and pretty significant price advantage. We're talking potential savings of almost 10,000 RMB on the purchase tax. That's a massive incentive to choose a NIO over a competitor. Okay, so they're selling cars like crazy, and they've got this killer tax advantage. So how are they going to finally stop losing money? Well, they've laid out a very clear and actionable plan for this year. Really, the whole strategy boils down to one word: discipline. The goal is to squeeze more profit out of each car, aiming for a 20% margin. At the same time, they're putting a cap on R&D spending and keeping marketing costs under control. And the big prize they're aiming for this year? To finally break even on an operational basis. And they're not just going to get there by cutting costs. They are fueling the plan with a whole wave of new products, specifically new SUVs, which are typically high-margin vehicles. This product offensive is absolutely key to hitting those sales and profit targets. So what do the big Wall Street firms think about all this? Well, it looks like they're buying into the plan. You see analysts from major banks like Morgan Stanley and UBS, and they see some serious upside. Their price targets are way above where the stock is trading today. The general feeling seems to be that if NIO can execute on this plan, the stock price will eventually have to catch up to reality. And that brings us right back to the central question, doesn't it? NIO is roaring into 2026 with incredible sales momentum, a one-of-a-kind strategic advantage with its battery swap model, a disciplined financial plan, and exciting new cars right around the corner. The paradox has been a story of a great company with a weak stock. The question now is, will this finally be the year that the two are brought together?